Namaste viewers. Today, we have Mr. Umesh Kumar Mehta, the Chief Investment Officer of Samco Mutual Fund with us to share his knowledge and thought process. This has two purposes. One is they are coming out with the NFO new fund offer in the actively managed momentum fund category. So earlier, currently we are having many index funds on the momentum category. Now Samco is coming out with an actively managed momentum fund. That means they are trying to, give better returns than the index fund, index momentum fund. He will share his thoughts on the NFO, the Samco group, and how they are going to manage from as simple as what is momentum. So he will address all those questions. And Samco Mutual Fund was started a few years ago, but they have a long lineage from securities point of view. Samco Securities is there for quite some time, and Mr. Umesh has deep knowledge about securities market. He is with the Samco Group itself for the past 17 years. He is a vivid speaker. When I met him in person a month ago, I was really amazed with the amount of energy that he has and the way of articulating things, all those things. So that's why I thought of having this conversation with him along with this NFO. Umesh, vanakkam, namaste.
Vanakkam, namaste. Thank you for inviting me.
Yeah, thank you, Umesh, and thanks for accepting our invitation. If you can, tell us about Samco Group to our subscribers, and the birth of Samco Mutual Fund.
Yeah. So in 1993, we established ourselves as Samruddhi Group of companies into traditional stock broking. And in 2003, 20 years later, we rebranded ourselves to 2013. We rebranded ourselves to Samco. So we were the second to enter into discount broking. So Zerodha was obviously number one. We were the first to bring celebrity as brand ambassador. No other broker ever did. We were the first to bring trading leagues on Indian shores. No other broker did. And therefore, the thought process was, unless we innovate, unless we add value to our traders and investors, we will not be able to move the needle. And in 2013, our all India turnover, the turnover ranking was, we were below 240. Today, we are in top 40. And this is how we have built our broking business model on the foundation. Let's innovate. Let's add value to our investors and traders. So 2021, we got final approval of SEBI on the mutual fund side. G.N. Bajpai ji is our chairman of Samco trustee company. Shri Ashok Kakkar ji is the chairman of our Samco AMC company. He was a former executive director at SEBI. So we have a marquee board and we are new age in AMC. Our thought process is that we want to deliver high returns to investors. And when we embed technology and add our fund management skill, I think that is where we will be able to create what investors want. Out there on this world, there are people who are generating outstanding result, and they are able to do it because of technology and the strategy that those guys are using. Some of them also we have brought for India, and as we will talk about during the later, how we will be able to, how that outstanding momentum as a strategy generates outstanding results. So yeah, this is our group, our pedigree, and how we have built our business from broking, traditional broking to discount broking to today as an asset manager.
Okay, great to hear that. And as we converse going forward, you can use any slides if you want. If at all you want, you can share your presentation. Now multiple people can share here, so you can share your presentation. Now from June 15th, you have opened your NFO, new fund offer called Samco Active Momentum Fund. So it seems to be one of its kind. That's why we are having this conversation. For if it is a regular fund, probably we may not have had this conversation because it is already known to people and a lot of investors. So this is one of first of its kind, I think, in this category, actively managed momentum fund. First, tell us, our viewers, what is momentum? What is this momentum strategy of investing?
Correct. So there are these two schools of thought for investing. One is we look at fundamental, we look at company, the growth, corporate governance, the product, the margins. This we call as fundamental analysis. The second school of thought is we look at the price, and whatever stock market gives out data, we scan those data. This we typically people call technical analysis. This is short-term trading. But out there on this planet, if we see the top 10 best brain, first is Warren Buffett, and he is leaning towards look at the company and the fundamental. But the second, the third, the fourth, Jeff Yass, Jim Simmons, they look at price. They are looking at market in order to generate return. And you will be surprised. They have generated more money than Warren Buffett has generated. His net worth is $106 billion at the age of 92. These guys have generated hundreds of billions of dollars of profit for that fund, and they all are looking at price. So what is momentum? So if we want to make money in stock market, looking at price, so then we have to get the demand supply equation correct. Where there is demand, we buy, and that is how we will be able to make money. So mathematically, if we want to code demand supply equation, momentum is the strategy. What is momentum? Now let me define. Momentum is the strategy is to buy past winners with the strategy that they are likely to continue perform well in near to medium term. So proven winners are to be bought, and so long as they are proven winners, they are running faster than the market. Momentum is all about buying stocks which are running faster than the market, stocks which are showing price leadership, and you hold on to them till the time they are running faster, and then you sell. So momentum is all about actually buying and selling. It is the other school of thought is that investing is all about buy and hold. But momentum by very nature, because you are buying stocks that are running faster than the market, and sooner or later they will slow down. So the moment they slow down, at not exact point, but steadily, you will have to get rid of them. So this is all about buying and selling. And this is what momentum as a strategy is all about.
Okay. Now I understand. So you want to catch the runners, which is the horses that are running fast or that can run fast till they have full energy. And now you have to explain me or our subscribers how this momentum fund management is different from that of actively managed hundreds of funds are there available right now in the market. So how do you differentiate, or how do you manage differently from that of actively managed funds?
Correct. So let me first give you an idea of momentum. Basically, how differently currently momentum as a strategy is what we are doing, and the current set of active fund managers currently that are available in the market. So momentum is all about, as I told you, it is all about buying and selling. And your active fund management is all about buy and hold. Mm-hmm. So where is the real crux? The defining line is this. Momentum entails you are buying a 100 rupee stock. So there are 2,000 stocks available at National Stock Exchange. A 100 rupee stock, when it becomes 70, 80, it becomes a value buy, or it becomes, stocks becomes cheaper. Now it's time to buy. So this is what entire rational investor would like to buy. But what is momentum? Momentum is all about, he's not going to buy a stock, 100 rupee stock at 70. He's going to buy 100 rupee stock at 110 and not 100 also. So basically, when you are buying stocks that are making lifetime high, stocks that are running faster than the market, and therefore, this is what momentum does, because many people can't do it, because we are all rational and we want to lean on the side that we don't have to lose money. And this is what Warren Buffett had said, do not forget rule number 1. And this is how, so therefore, we would lean towards buying stocks that are available at value, or stocks available at discount. So this is all about buy and hold. But momentum is all about buying stocks that are running faster than the market. And therefore, sometimes you will have to sell, because the moment they slow down, they are going to fall steeply. And because they will fall steeply, as a matter of the implicit in this entire momentum as a strategy is that you will have to buy, and then you will also have to sell. So this is what the difference is. So giving you an analogy, in a school, the momentum is what about he goes in a 5th standard and then identifies who is this boy or a girl who has consistently stood first or second in first, second, third, fourth, fifth. And in class 5th, he's betting that now for next 5 years till 10th standard, this boy or girl is going to remain first or second. This is momentum as a strategy. But the general thought, the concept, the traditional approach is they will go in class 1, the first standard, and out of all 40 students, they will try and identify a boy or a girl which has got a great potential. They will either see their astrology or the track record of parents or whatever number. So this is what fundamental analysis is all about. They are trying to find a company which will become great, and therefore they will use all sorts of analysis. Momentum as a strategy is that we are buying proven winners, stocks that are all there, that have already delivered high returns, stocks that are showing strong price leadership are the ones are to be bought, and they are to be bought for some more time because eventually they will fall, and therefore hold on till the time they are running fast. So this is what momentum as a strategy is all about, and this is what the difference is in terms of the traditional school of thought for fund management and the school of thought of on the momentum side of fund management.
Okay. So you will be more proactive, and kind of your tools will be little different from that of active fund manager, regular fundamental analysis people that they use. So you should have a lot of technology. I mean, everyone has technology nowadays, but to run through so much of data and everything, you will need more technology support. I presume. That's what I presume.
So I also forget the proof of concept. So for a layman, it would be that if you are buying stock at lifetime high and compared to a strategy investor who buys stocks at low valuation, already the gap is huge because he's already missed from a 70 rupee run to 110, right? So this is, but the proof of concept, momentum guys are making a lot of money. Jeff Yash, as I told you, the third richest person on this planet, his strategy is momentum. And the kind of return MSCI maintains. So now if you permit me, I can show you, show those, the slides, which I want. Yeah. So momentum as a strategy, MSCI maintains a world index and a momentum index. So momentum index has delivered 20x return and world index has delivered 10x return. NSE also maintains strategy index. So they have this bucket of strategy index, broad-based, thematic, sectoral, fixed income, and one is strategy index. In strategy index, momentum has delivered highest return in their strategy bucket, 21% CAGR from 2005. So momentum as a strategy has proof of concept. Those who are running momentum as a strategy are making a lot of money, and therefore this is not new. Momentum makes a lot of money. But on the mutual fund side today, we Samco Mutual Fund, we are launching this as an actively managed fund on the momentum side. So let me share this quickly. The slide that I wanted to share on the momentum as a proof of concept, that how momentum makes a lot of money. So there are these two schools of thought I have already shared. One is the voting machine, the price side. This is where momentum as a strategy works. These are the second or the fourth best player on this planet are making money. This is weighing machine, the fundamental side, the rational investor, the Warren Buffett way. The fundamentals look at quality, growth, corporate governance, etc. And this is what the proof of concept is. That these are these research papers. They have said that stocks with high past return tend to have high future returns. And this anomaly, and this is tested over the last 215 years across asset classes, that momentum is an alpha generating strategy because intuitively majority human beings can't do it. And those very few who are able to do it are generating a lot of money. So what is momentum? It refers to tendency of winning stock to continue perform well in the near term. And the proof of concept, MSCI research shows historical basis, the momentum factor has been the most strongest generators of excess return. So the red line is the MSCI World Index has delivered 10x return. The momentum version has delivered 20x return. Across all time periods, momentum has generated high alpha over and above broader market. Does it work in India? Yes. This is Nifty Midcap 150 Momentum 50. The strategy index I was referring has delivered 21.28% CAGR return since 2005. And this is the base index, Nifty Midcap 150. The red color line has delivered 13x return. the momentum version, the fastest moving 50 stocks out of 150 has delivered this kind of 32x return historically over a par from 2005. So there is this one more strategy index, Nifty 200 Momentum 30 has delivered 17.5% CAGR return since 2005. This is the yellow line is Nifty 200, India's top 200 stocks. 30, Momentum 30, the fastest moving 30 stocks, the best moving available in the universe of 200. This is what the alpha or the historical returns that Momentum as a strategy has generated. So the broad-based index has delivered around 12.5% return. Momentum as a strategy has delivered 21.5%, 21% return. And this is since 2005 on a like-to-like basis. So therefore, there is enough and more proof that Momentum as a strategy does make alpha for investors.
Okay. No, thanks for sharing the data. It precisely shows how much difference the alpha being generated on an index level. So now you are going to do it on an active side. So you are going to manage actively. So the expectation is you should be doing better than the index. Am I right?
Correct.
Okay. So there are a few. Now you have shown the index, but there are already a few passively managed funds available in the market with the momentum theme. You are the first to come out with this active management. Now, how this will be different in the sense, say like you showed that Nifty 150, Momentum 50. So instead of Momentum 50, probably you might be picking Momentum 25, something like that.
Yeah. So I will come to the strategy, how we will generate alpha and what are the gaps currently in passive, and we as active fund manager, how we will add value to our investors. I think that is what the crux of our today's meeting is, and that is what we will cover in next 10 minutes. Before coming to that, so these are the currently passive funds. The size is around 2,000 crores. And there are these 6 funds, but they all are on the passive side. And now let me straight away come to the strategy. So what the strategy that we at Samco Mutual Fund is, this is the strategy to invest in stocks that are showing momentum characteristics and to sell the stocks that are losing momentum. So as I told you, this is all about buying and selling. So let me show you this example. This is alkylamine. The green color is the buy momentum signal over here, and the red is the anti-momentum signal. So this is how large trend emerge. It is the promoters, the insiders who initially buy, and then your FIIs, the retail investors all came in, and this is how large trends emerge. So now let me give you the next slide will give a detailed insight into why we were able to buy not at the bottom and why we were able to sell not at the top but over here. So this slide is very interesting. So this same alkylamine, April 2020, there was this buy signal that got generated. But a rational investor, when he looks, the quarterly available numbers were of March. When March numbers, he will say that, oh, the companies is not doing, the performance is below par, and the quarterly profit growth was 1% negative. June was obviously bad because it was COVID impacted. September quarter result, when it came in sometimes in October, 24% profit growth. So now a rational investor would think that, oh, wow, this company makes sense and there is growth in the company, let me buy. So this is around 2,000 rupees when the numbers actually came out. But momentum guy got signal over here when the prices was around 750. So now this point is important. Alkylamine, price had already moved up by 50%. Stock had made lifetime high. Fundamentals, the numbers were poor. It is only a momentum guy, as a strategy, he will be able to buy because his focus is price. As I tell you, there are these 2 schools of thought. This momentum is all about, we have to look at price. And when the score, the speed of alkylamine was 5. Alkylamine was the 5th fastest moving stocks in entire Nifty 500. And this is what momentum as a strategy does, which otherwise rational investor would have never bought. Stock is up by 50%. Stock has made a lifetime high and numbers are poor. Which rational investor would have ever bought this stock? None. And this is what momentum as a strategy does, because when not others are doing, as momentum as a strategy does for this investor. And when prices are corrected by 20%, then only the system will recognize that, oh, now the momentum is slipping, it is entering into anti-momentum, let's sell. So this is how momentum as a strategy works. When they will not be able to identify at the bottom, no, that is not the strategy. Momentum is when stocks run up, when they prove winner that, oh, now you are the 5th fastest moving stock in Nifty, that is the time you will get. So this is how momentum as a strategy works. I think this example will clearly give an idea.
Yeah, great. This is a great one. The one question subsequent to that is a normal person will have. So like there are a lot of small cap or penny stocks which are making highs. Someone is operating it, etc., etc. So do you have checks and balances to avoid such stocks from sitting?
Correct. So this is a very good question. So there will be certain stocks. So what we have done is our universe we have defined as 750. So top 500 and the balance 250. But there are 2000 plus stocks available in market. So all those stocks are out. Within 750, the next below 500, there are 250 stocks. Within 250 stocks, there are certain stocks which are circuit to circuit, where they have low liquidity, low volumes. So all those stocks we will remove from our universe, because those are the stocks which we will get caught, or stocks that are. So we have maintained our basic hygiene check about volume, about volatility, about the caps, so that we scan our algorithm on a universe of solid 750 stocks which are reasonable and which will be able to the lower 250 stocks will be able to generate high multi-bagger stocks from that category, and the 500 stocks will have a bigger and a stronger universe to scan upon for our momentum algorithm.
Okay. And now the important question is, why should an investor consider your NFO? I mean, this Samco mutual funds, the new fund offer. Is it, people generally tend to, apply to a new fund. It should give me better return than the existing fund. That is most of the time, that is the question the investors ask, will I get higher return if I invest in this NFO? Something like that. So is it expected to give higher returns than actively managed fund? You showed me data point, but I want to hear it from you.
Yeah. So again, I will obviously I will say what is needed for the investor, but let me show you again what are the data points that we are relying upon. So these are the 5 things that we as fund managers, we will do ultimately to deliver alpha over and above passive. So what are these 5 things? The first thing is passive remains invested 100% of the time, whether the market is in bull market or bear market, they will have those 50 numbers. So currently what we are looking at is 150 mid cap 50. So that is the strategy index that we are looking at. So they will remain invested at all times. But we, active fund manager, during anti-momentum period, we will run we will hedge our portfolio. So the downside we will be able to cap. So for example, if markets fall by 50%, NAV will be down by 50% from a traditional fund management perspective. But over here on the momentum side, probably we will be able to save the bottom 20. So we will hedge our portfolio the moment market prices are falling, because the algorithm is live, active daily. So they are monitoring the prices are falling, they will hedge the position. So let me give you an example of this. So this red color period, the balls that you see, they are anti-momentum period. And during this anti-momentum period, our positions will be sold and we will run like an hedge fund. So if I want to expand these 2 positions, let me go back to 2 slides. This is global financial crisis 2008, system at 42 open positions. And 34, it was able to exit. After exiting, market had fall. Market took a beating by 43%. See, when prices are falling, system knows every day that prices are falling. So it will get out from the position. This is the beauty of momentum as a strategy. So at times, if markets are falling very deeply, all the positions will be squared off. And then we will remain invested in Nifty 200, all F&O stocks, and we will sell the futures so that we hedge the downside for our investors. And this is one more COVID. 40 positions were there on 1st of March. 29 it was able to sell. and 11 positions were still there. After selling, market had fallen by 23%. So this is how we will protect the downside. So this is point number one, exposure. Second is rebalancing. So passive does rebalance after every 6 months. We will do rebalance because we are active. We will do as and when needed. Third point is passive uses only relative momentum. So what is relative momentum? Relative momentum means the 50 stocks compared to 150 stocks which are running faster than the market. In bull market, that is the portfolio. During bear market, 50 stocks which are falling the least will form part of portfolio during bear market. So they do a relative comparison. We also do absolute and relative both. So next slide, I will show you example what we mean by relative and absolute. And then second last point is number of stocks. So for passive, the portfolio can be either 50 or 30, depending on what strategy. But on active side, there is no limit. We will either remain invested at 0 or we will have investment of 60, 70, 100 stocks, depending on the market momentum and depending on the bull market. And the last is universe. Passive will have a universe currently of around 150 or 200, and the unique stocks are 250, combining two. For us, the universe is Nifty 750 stocks. So the stocks below 500 are the ones which we see maximum momentum, and these are the stocks which do become multi-bagger stocks. So now let me straight away come to the example. This I have already covered. Passive remains 100% invested. We will run like an arbitrage fund. We will hedge our portfolio to the downside, and 6 months rebalancing. This is what passive does. So this is ICICI Security. The green color signal is the active entry exit signal. The red signal is the passive entry exit signal. So when ICICI Security, the stock price started to run up, here the active fund got a buy entry over here. Passive was able to get buy entry over here. Active took an exit here because the momentum was falling. This momentum was very sharp. This momentum was slow, was coming down. Passive took an exit here. So active fund manager was able to get only 8% profit, but passive got lost 46%. So why they lost 46%? Because they rebalance after every 6 months. And we are active fund manager. We will do rebalance as and when needed. So this is important point. Why passive has gaps, and we active fund manager, we will be able to do more value for our investors. This is an active buy signal. Passive got buy signal over here. Active got an exit over here because the momentum was veering away. No one is got and no one will be able to catch the tops. Passive took an exit here. Eventually, active fund manager was able to get 266% profit. Passive was only able to get 76% profit because they rebalance after 6 months. The active fund manager will do rebalance as and when needed. And passive uses only relative momentum and ignores absolute. This is the example, Scaffler India. So active fund manager got a buy signal here. Passive got buy signal here. Passive took an exit here. So when we checked why passive took an exit here, because they identified a 51st stock which was running faster than the market, and therefore they switched. For active fund manager, there is no limit. Either they can hold 60, 70, 100 stock. There is no fixed limit that they have to hold only 50 stocks. Because the trend was running and you have to let your winners run. So active fund manager took an exit here when actually the trend got exhausted. So 59% more profit was generated because in passive follows only relative. They have only fixed number 50. Active fund manager they follow absolute momentum. They can have more stocks or less stocks. This is the difference between relative and absolute. And last, one more example, this Federal Bank. So during falling market, as I told you, passive will create a portfolio of 50 stocks which falls the least. And therefore, Federal Bank was the strongest, and therefore it had fallen the least. And therefore they added in the index. So they got added over here and they got exited over here. And ultimately passive lost 27%. It is a falling market. We follow absolute momentum. For us, absolute slope of price momentum is important. If it is positive, then only we will remain invested. Otherwise, on the downside, on the bear market or anti-momentum, we will run like an arbitrage fund. We will not buy. Therefore, we did not buy and sell this Federal Bank, and therefore we saved investors 27% as active fund manager. because we follow absolute momentum as well. So how alpha will be generated? Index methodology is the base case, plus we will run our proprietary absolute momentum algorithm, plus we will rebalance as and when needed, plus we will capture anti-momentum, and this is how we will be able to outperform the momentum indices.
Okay. Anyway, you have already shown that momentum has done a fabulous job as compared to regular indices. So accordingly, in this case also, and when we compare with the momentum index also, you should be doing a better job. That is the overall take from this presentation. And to coming to a point, who should consider investing and how much? Do you have a figure? A thumb rule kind of thing?
See, broadly, there are experts out there, the global advisors, what they say that momentum as a strategy, investors should have around 20% in their portfolio. So now to a layman, this may become huge. Oh, 20% is huge. But actually, if you think, no, see, just like a cricket, there are 10, 11 player cricketing team. You need 2 players who can hit fast, 6s and 4s, so that the score of the entire team becomes a winning run rate. So in investors' portfolio, if they have 20% invested to momentum as a strategy, because this is a high alpha generating strategy, and I explained you this works on the price action. So this is a unique combination. No other strategy does this. And therefore, in order to take the run rate of entire investors' portfolio from a low tin, mid tin to high tin, this strategy makes sense. And ultimately, everyone wants to make more money. So they will have to smartly they will have to allocate money where they are able to get high alpha and therefore take their entire run rate of the entire portfolio to higher levels. And therefore aggressive allocation needs to be taken on the momentum side.
Okay, minimum of 20%. That's what around 20% you are suggesting from the practices that is out in the world. Okay. And are there any actively managed momentum funds in developed markets such as US or Europe or UK, wherever? Are there in present right now?
See, today we are naming it, and as a strategy index, people are using momentum as a name. But there are fund managers, hedge fund managers out there on Trans-Pacific. People are generating 30%. So trend followers like Ed C. Kota, he openly says that my system, I have a signal in my laptop, and the dealer comes and he places the order, and he's managing multi-billion dollars, and he has generated 30% CAGR not only for 1 year but consistently for so many decades. So today we have also built, because it's not possible to do it manually. So we have also built our algorithm. Basis that algorithm, we also know that now this algorithm will work, and we will get signals and we will place in our system. So this is how we will also reduce our errors, our emotion, our greed, our fear, and we will do perfectly, because it is machines that do things perfectly. Warren Buffett, also the biggest, richest investor, during COVID fall, he was also not able to buy anything. Although he had said that when everyone is selling, you should buy. But it is a system that is going to win this battle. And we have also created that system, because systems are unemotional, unbiased. They will not make mistakes, error. And this is how we can make high alpha for investors.
Okay, good. And generally, in the past, going by the historical average in Indian market, how much alpha one can expect from, let us compare passive to passive. A passive momentum index fund and, or an active, a passive momentum fund and an actively managed momentum fund. How much could be the difference in alpha?
See, there are 5 things that we are doing, and what those 5 things are, I think this is sensible, logical. Number first is we are protecting the downside. So we will we will hedge the portfolio during the downside. So that's point number 1 for alpha generation. Second is rebalancing. So rebalancing happens 6 months on that side, because we are active fund manager, we will do it on a real-time basis. The universe, currently the universe is 150 stocks. Our universe is 750 stocks. The universe is huge. There are so many stocks out there in the small and micro space where when they generate, when they are in momentum, they generate a lot of price run. So these are the things that investors have to look, and the absolute and the relative difference. we will have more stocks. Passive has only 50 limited number of stocks, because in bull market there are 60, 70, 100 stocks that are running faster than the market. So our aim as fund manager is to capture everything for our investors. What is running faster than the market, let's add them to the portfolio, and then do a quick switch if they don't work. So this is how, when we do, alpha will be generated. And given when you are running on 750 market on a real-time basis, and this is what, when you run an algorithm, I think money will get generated year after year. This is money making machine. I think there are no emotions, there are no greed, fear. This is a compounding machine, and people, and they're out there on this planet, the people who are making money currently are all dependent on algorithm. They all are working on automations. Today, we on mutual fund side, see, people are doing trading. People are probably paying tax if they are making money, 30% tax. This is the same sort of trading fund which is available at a 10% taxation. I think this is huge. And on the more mutual fund side, I think this, for our investors, at this fee, low cost fee, I think this is one of the best feature that we can offer from a new.
This is a very catchy point to make. I fully agree with you that traders are paying 30% or highest tax bracket for trading every day in and out. But you have an arbitrage here. The true mutual fund route, you are doing a better job than them, than an individual trader. Definitely you should be doing at 10% long-term capital gains, provided if they keep for a year. It's a wonderful catchy point for many of the traders out there in the market, or who want to make quick money paying higher tax rates. That's a very valid point. Also, earlier in our conversation, you mentioned that number one is the fundamental guy. Number 2, 3, 4 are traders. I won't say traders, momentum guys who use a lot of mathematics and all those things to get analytics to get that winning stock. So I think, if I am right, I have seen it in your presentation. Can you show that who are those guys, so that our subscribers understand there are people out there who make billions out of momentum?
Yeah, why not? So my slide is visible, no? So my slide is visible, no, sir?
Yeah. Okay. This is Ken Griffin.
Yeah. Ken Griffin, Jeff Yash. Jeff Yash is a guy who does momentum. Jim Simmons, Medallion Fund. This guy generated $100 billion in 20 years. Jeff Yash, momentum guy, Ken Griffin. So this first three, they look at price. This three, in fact, this 3, 4 look at fundamentals. Ray Dalio also looks at price. And again, Carl is a mix of both. So I think this is how the magic has changed. If we remove Warren Buffett, that equation, I think, has absolutely changed. The top 3 guys, they all look at price and are making a lot of money.
So second, third, fourth, and then Ray Dalio, the 9th guy.
Correct.
So 4 out of 10 top guys are using momentum strategy. That's good. I mean, can investors invest in this fund post NFO? After, I think, June 15 to 30 is the NFO period. Post that, will you be accepting money?
So post NFO, we will not accept money, because see, what the difference is, out there, the traditional fund is all about buy and hold. It is all about invest, and they don't think of selling. Here, it is all about strategy. It is all about buy and sell. So the moment on 29 June, the fund closes, we will allocate all the money as and when the signal comes. Once we deploy our money, then again we will open with a short notice that, look, we are open for money. Because till the time money is not deployed, there is no point. And this is all about buy and sell. If I get a signal, I'm going to invest. So this is where the difference is. Over here, it's all about buy and hold. So you keep on giving money, you keep on adding stocks, because they don't think of selling. So my strategy is all about selling also. So for selling, I need to have a signal. It is all about buy and sell. Therefore, we will take funds once we fully deploy our money. When that can happen, I don't know. It can happen 6 months, 9 months. There will be elections. How sentiments will pan out, I don't know. But yeah, the moment we deploy our money fully, and if momentum signals are coming, then we will open for fresh inflows and SIP. Otherwise, for 15 days, whatever lump sum we get, otherwise, whatever SIPs we get in the first 15 days during our NFO, we will accept, then we will close it.
Okay, okay. So both SIPs as well as bulk, you may not be accepting after completion of the NFO. Okay, okay, that sounds good. And what is the minimum and maximum investment in this NFO?
So minimum investment 5,000 and a multiple of 1. Maximum.
Correct. No, just because
Every
most of the
investor.
time, our investors think that, will that be a large amount? This is like any other mutual fund, you will be accepting minimum 5,000 rupees and, maximum any amount for now until during the NFO period. Post NFO period, it is subject to your decision. I understand that. And one more thing, the level of energy that you have, I want to get some. Even when I met you in person here in Chennai and, during the talks and all those things, you are passionate about it and, you articulate very well and you have a very good tone. Where do you get all these things from or how to get? I want to borrow some.
So it is all about ultimately grace of God. But let me add a little bit thing. I'm passionate about stock market right from when I was, when I became adolescent. For that matter, 10th standard was Arshad Mehta, and this is what I still remember those days. Arshad Mehta scam broke out. So that when we start early in our life on the passion that we have, stocks, finance, capital market, I think that automatically gets into that DNA and the learnings, the mistakes, the value that we want to give to our investors, all our entire surrounding, the breathing, the dreams, everything is all about markets. So this is when one goes into that level, I think this then energy and all this thing is all automatic and nothing. And ultimately, it's the grace of God. There is nothing more or less that I'm doing, but ultimately, whatever is, I'm thankful to God for whatever He has made me and whatever I am today is ultimately grace of His God, my God, and my parents and my gurus, mentors, and obviously partners like you who also encourage. I think that's a great. World is really great, and we all should celebrate. And I think this fund is also great. We want to deliver high return for our investors, and I think we are very excited that when we bring this investment product embedded with technology, I think this is what gives us and more excitement that ultimately it is the systems that is going to win this battle. And there is a proof of concept. If we keep on doing consistently what we are doing and what we have built, I think we will create a lot of money for our investors. So they have to.
Great, Umesh. And the one good thing is you are bringing a strategy that is, meant for the elite group, in the sense elite investors who can invest millions of dollars or, crores of rupees, that you are giving at 5,000 rupees to a 5,000 rupees investor also, and even an SIP of 1,000, 2,000 rupees can be done in this fund at this point of time. Anyway, that is great, and you are, I would say you are socializing the elite investment strategies to common people. That way, I really like, what Samco is doing with this funding from the strategy point of view. Appreciate and best wishes for your NFO. And probably next time when you are in Chennai, let us meet up and, take this forward conversation.
Yeah.
Thank you.